Hello and welcome to our discussion of the high-low method of cost estimation. In previous sections we have talked about variable and fixed costs. However, in reality, some costs are both variable and fixed. They have a fixed component as well as a variable component. These types of costs are known as mixed, semi-variable, or semi-fixed. One classic example is that of utilities. If you connect utilities to your house or your business, and you go away for the month and you shut every single thing off, unplug everything, shut everything off, you're still going to have a monthly bill. You're charged a flat rate just for having the connection, plus you're charged a variable rate per kilowatt hour if we're talking about electricity. So that is an example of a mixed cost. It has a fixed component as well as a variable component. Now with the example of utilities, you're probably going to be able to identify what the flat rate is as well as what the variable rate is. They'll probably publish that for you on your bill. However, in reality, not all costs work that way. Some costs have a variable and a fixed component, and you cannot easily identify what the mixture is. Now, this is important to understand what the variable and fixed components are, because we're going to use that data to try to predict cost at a future activity level. So what I have in this middle bullet point is known as the cost equation. Y equals A plus BX. This is going to give us the equation for a particular line on a graph showing how cost will change as activity level changes. This equation may look somewhat familiar to you from basic math, graphing, charting. It's also known as the slope-intercept equation from math. It's the same concept behind it. In both cases, we're trying to find out how the line looks on a chart, how it slopes, where it intersects the y-axis. So let's break that equation down. Y equals our total cost. This is what we're trying to figure out based on the activity level and the various rates. This y is known as the dependent variable because it depends on what the other variables are. We can't calculate y by itself without knowing the other variables. It depends on what those variables are. A is known as the fixed cost or the intercept. So this one letter represents our fixed cost in our equation, and it also tells us where the cost line intersects the y-axis. Keep in mind the y-axis is where we have zero level of activity. So that tells us that we're going to have this cost even if we sell no units. It's a fixed cost. B is the variable cost per unit. It's a rate per unit. Now this tells us above and beyond the fixed cost, how does the line slope upward, increasing cost as we have more units of activity. This is sometimes referred to as the slope. Finally, we have X. This is the activity level itself. So this is what we plug in to try to identify what cost will be at that activity level. We're guessing at what cost will be at 1,000 units, 2,000 units, 3,000 units. So X is an independent variable. It does not depend on what anything else is. In fact, it drives what Y will be. So X is the independent variable that we plug in and calculate what total cost is based on everything else. So this is one you'll want to take a little bit of time to practice and recall the various variables and their terms, their names, because this is one that often comes up in various quizzes or tests. So here I have just a basic graph of a line. Now notice that this line, of course, it slopes upwards. As we sell more units, our cost increases. But you can see that it intersects the y-axis right at the 300 unit point. So I know it's kind of hard to see there, but it's right about the 300 unit point. What that tells you is that at 0 units produced or 0 units sold, we still have $300 in cost. So if you go over to our chart here, this is actually the chart that drew this line. At 0 units, we have $300 in cost. At 10 units, we have $400 in cost. 20 units, we have $500 in cost. So what you can actually tell here, this is intentionally a very basic problem, you can tell that 10 additional units cost another $100. So we went from 300 to 400 by just increasing to 10 units. We do the same thing again when we increase from 400 or from 10 to 20 units. Another 10 units, we increase another $100. So what you can tell there, every 10 units cost $100. Therefore, every 1 unit must cost another $10. Just by looking at this chart without doing any crazy math, we can find that 1 unit, the variable rate is $10. So what we have down here for the equation of that line is that Y, total cost, equals 300, which is our fixed cost, plus $10 times X, or 10X. $10 variable rate times X number of units. Now that's a basic problem. They're not all nearly that easy where it's an increment of 10 and 100. But that just shows the basics of how the concept comes into play. Now what you're generally going to see with these types of problems is you're going to be given a range of data. It could be every month throughout the year. It could just be 20 different instances of cost and activity. You're going to have to take that data and perform one of these 3 analysis methods on it to determine what your cost equation is, what your cost line looks like. So the first method we have is the scatter graph method. We're going to see a little bit of this in a later slide, but basically what it means is you take every single point, you plot it on the graph, and hopefully your points will somewhat represent a line. Now they're probably not going to be perfect because reality generally isn't perfect, but you should be able to visually see that series of dots and visually figure out where a good line would be that intersects that series of dots. So that's the scatter graph or visual fit method. Again, the whole point is to identify a line and how it fits through that. I'll show you that portion in just a bit. The focus of this lecture, however, is the high-low method. This is a calculated method. It's not perfect, but it's a little more accurate than the scatter graph. And then finally, the more complicated method, which is outside of the scope of this review, is the regression analysis method. This is a method that basically, it's also known as the least squares regression analysis. And I'll mention what that is when we get to that scatter graph in just a bit as well. But basically this uses either Excel, you can use computer software. It's something you don't do manually because it would take a very, very long time and several repeated calculations to do it manually. But it's similar to the scatter graph except that it finds the perfect line, it finds the best line that intersects all of the dots with the least amount of error above or below. So again, I'll try to make that clearer in just a little bit when we see that line. First, we're going to spend some time talking about the high-low method. So for this method, as the name implies, step 1 is that we have to identify the highest and lowest activity levels. So what we're going to be given is a range of data, maybe 10 or 12 or more instances of a particular activity level and its corresponding cost at that level. Now, generally speaking, your highest activity level will probably be your highest cost, and your lowest activity level will probably be your lowest cost. However, that doesn't always hold true, and to be honest, we don't care about it. We are concerned with pulling the highest activity level and whatever cost corresponds to it, and the lowest activity level and its corresponding cost. Now, the other thing here, when we see this range of data, this may make a little more sense, but if we see any major outliers that are just far away from the pack as far as the numbers, we may want to consider eliminating them because it may skew our data, especially based on the fact that we intentionally use highest and lowest activity levels. So if you see a high activity level that is just way, it's triple or quadruple outside the next highest range, then we probably don't want to use that because it won't be a good reflection of our normal activity. So you may just want to flat out exclude it from our analysis. So that's step one and step two. Find the highest and lowest activity levels and whatever their corresponding cost is. And then step two, we can plug those in to our calculation. Keep in mind, we're trying to calculate a variable rate per unit or a cost per unit. As such, we divide the costs by the units or activity. So that's the first thing you need to figure out is what order does this division go in, and it's the cost divided by unit to get a cost per unit. So what we have to do in the numerator, we're taking the highest and the lowest costs, subtracting them. So in other words, the difference in the cost divided by the difference in the activity levels, highest minus lowest. The thought is that this will give us the amount of cost that's explained solely by the change in activity. This amount of additional cost was related to this amount of additional activity. So that should be solely variable. Now step three is to take that variable rate that we just calculated and plug it into our cost equation. Remember our y equals a plus bx. Plug it into that cost equation. That would be the b, using either the highest or lowest activity levels. It has to be one of those two that you used in the calculation. It won't necessarily work at any other level. So again, now we know the b. We've just calculated the b, the variable rate. We also know the corresponding x. We know what activity level we used. Again, you could pick either the highest or the lowest. We know the total cost because we know the cost related to that activity level. That's the total cost. So now that you know three of the four components, we can now calculate the fixed cost. So let's take a look at an example here. Now before we go any further, this is the scatter graph method I mentioned. This particular chart shows January through December total units produced and the total cost for those units. So if you plot those all out on a graph, it's not a perfect line. It goes quite a ways all over the place. But your goal would be to find a line that looks like it does the best job of trying to match up with this general slope. So you'd plug a line in there. Now the other thing I want to mention here is that you're going to have errors above and below that line because they're not going to all fall on that line. The regression analysis method takes a look at those errors. It squares them. Now the reason it squares them is to always get a positive number. Because if you think about it, if you have some positive errors above the line, some negative errors below the line, a lot of them are going to offset. You could theoretically end up with zero errors, which would make it look like a perfect line, even though it was far from perfect. So you square the errors, in other words, the distance from that line to that point. You square each one, and then you add all the errors up, and you keep doing that with every possible line until you get the best line with the lowest amount of total error. So that's regression analysis, which is, again, outside of the scope of this discussion, but I just wanted to bring it up briefly. So now we've at least touched on the scatter graph and regression analysis methods. We're going to return our focus to the high-low method. So now what we're concerned with is the activity level, the total units produced. We're not really concerned with whether it's the highest or lowest cost, even though in this case it is. The highest activity level is also the highest cost. The lowest activity level is also the lowest cost. So it makes sense, but it doesn't have to be that way. So we want to look at the change in cost and the change in units. So from 1010 to 1940, that's a $930 increase that was caused by increasing the units from 58 to 120, so a 62 unit increase. In other words, 62 additional units cost us an additional $930, that makes sense to assume that's the variable cost. So if we take 930 divided by 62, that gives us a $15 variable rate per unit. Now, we take that $15 variable rate per unit and we multiply it by either the highest or lowest activity level, either one. In this case, we'll take the high, the 120. That gives you $1,800 total variable cost. Now notice, total variable cost is $1,800. Total cost overall was $1,940. So if total cost is $1,940, variable cost is $1,800, that tells you that there must be $140 in fixed cost. You would get the same amount if you took the lowest activity level and plugged that data in there as well. So now we know the equation y equals $140 fixed plus $15 variable multiplied by x. So at any point, we can plug in a new x and figure out what the cost will be at that activity level. But the key thing is we have to be operating within the relevant range. What that means is we have to be within our capacity limits. So we can't just say, well, maybe that'll work for 1,000,000 units as well. It probably won't. Our capacity appears to be somewhere in the 100s. It might be a little higher, but this is where we've been operating. So it wouldn't make sense to try to apply this line to 1,000,000 units or even 100,000 units. That's probably too many. Of course, we don't know based on this. Maybe they're always operating way below capacity, which is another issue altogether. But in any case, this is the way to use the high-low method. Hopefully that has helped to clarify this particular cost analysis method or cost prediction method. But as always, if you have any questions, feel free to let me know. Thank you. Thank you for watching my accounting video on YouTube.com. I hope you've enjoyed that information. Accounting can be a difficult topic to conquer, and sometimes you just need additional information or assistance outside of the classroom. If you feel like you need some additional information, some additional resources, come visit my Udemy.com course. I have a variety of financial and managerial cost accounting courses available that may be able to assist you if you're having trouble with a particular course. In these courses at Udemy.com, I have additional lectures on a variety of accounting topics. We also have downloadable Excel templates for all the various practice exercises we work, as well as a video walkthrough of the solution. I continue to update these practice exercises, so even after you join, you may see some new exercises. It's all geared toward helping you to understand the topics. So in addition to those additional lectures and the practice exercises, we also have quizzes and tests to help gauge your understanding of the topic. That may give you a better idea if there's something you need to go back and learn a little bit more about, read more about, watch a video on. We also have downloadable study notes that really try to drive that home. There's a downloadable textbook with it. So feel free to come join this class, come take a look at it. You can find this at Udemy.com if you search for Severson, or you can just Google Severson Udemy Accounting to see a list of all the courses that are currently available. Again, I'm working on new courses as we go. Right now you'll see some financial and managerial accounting courses out there. I'm working on the intermediate and advanced side of those particular courses as well, so you may see new ones out there as well. Now, email me for a special 50% off coupon code. You can send an email to chrisseverson@hotmail.com, and I will respond with that code. It's a different code for every course, depending on which one you want. I can also respond with the actual link to that course. Now, all courses at Udemy.com have lifetime access, and there's also a money-back guarantee if you're not satisfied. So come check out my course at Udemy.com and see if it may be a fit for you. Thank you for your time.